The buzzword for 2026 is affordability.
Affordability.
Everybody should get on their phone, call their politician up, and say, we want capital gain reform. You have some people who are not selling because they don't want to have to pay a capital gains of $30,000, $40,000, $50,000 on the sale of the house. They rather turn around, stay in the house, live in the house, and then will the house to their children where they have to pay zero capital gains. When it comes to that, if they raise the limits to $500,000 for a single person and $1 million for a married couple, the president does not disappoint. He throws it out there and see if it's going to stay. Welcome to the Real Estate Show with Pat Lopez, where we talk everything real estate. For this show, we're going to be talking about housing policies and affordability. So let's first jump into President Trump has nominated a new Fed president to replace Jerome Powell, and that is Kevin Warsh. Now, he was a Fed governor back in the early 2000s, so he's no stranger. He's an academic. Like I said, he was on the Federal Reserve Board in the past. So the thinking here is he's going to be more in tune, more in line to what Trump wants, and that is to lower the federal fund rate. Now, understand the federal fund rate isn't the mortgage interest rate, but over history and time, they do correlate, or they work in conjunction with each other. So they sort of mirror each other. Once again, the federal fund rate is the overnight rate that banks borrow. That is what the Federal Reserve Bank controls. But will Kevin Warsh be more in line with President Trump? Will he cut rates? We know that Jerome Powell will be in office until May, so we're not anticipating any cuts before May. Now, of course, the caveat here is employment. The Fed is tuned in, extremely tuned in to the unemployment rate, and that's really what they're looking at. They believe inflation is under control. So they are looking at the employment numbers. So if we have a drastic negativity in unemployment, or unemployment rates go up and there's job loss, then we could see cuts happen before Jerome Powell leaves office. So that's one big market mover thus far. More accommodating as far as the federal fund rate is what the thoughts are when it comes to the new Federal Reserve president, but understand he does need to get approved by the Senate. Are you thinking about buying, refinancing, or investing in real estate? I've been a loan officer for 30 years, helping my clients find the right loan for the right property. I keep it simple and honest. If you want real numbers and guidance you can trust, give me a call. Now let's get back to the show. Now, the second thing, a big headline, is Congress. They passed a bill. Now, Congress, 390 to 9. We're talking total bipartisan. And we all know the buzzword for 2026 is affordability. Affordability, affordability, affordability. And everybody's jumping on that wagon to say they're helping with affordability. And we're specifically talking about housing. Okay, so the bill was housing for the 21st century. Once again, 390 to 9. And what this talks about is zoning reforms, how to increase housing, also cutting regulations, red tape, those kind of things. Even it gets into manufacturing homes, manufactured homes, which tend to be about 20-30% lower in price to put together, and then allow the agencies, Fannie Mae, Freddie Mac, to make a financing of those homes more easier. And I will tell you, if you see some of these like modular homes where they build them in a factory, they come out in like 6 or 7 pieces, they're put on a foundation and they put them together there. First of all, the time to put everything together is much faster. That's why it's cheaper. The labor costs, all that is cheaper because everything's done in a controlled environment. But once the house is complete, I mean, you could put 2 houses next to each other. I would be amazed if you could figure out which one was, built in a factory and assembled, on the scene, or versus what was stick built. So we'll see if that comes about. Now, that's not going to be an answer for cities, but on developments, potentially where you have, land and you're going to put a whole community together, and that could drive some costs down. So these are some of the ideas, the zoning, cutting red tape, those kind of things that Congress wants to be ahead of, jump in front. The Senate already has a bill as well, so these 2 bills will have to come together and we'll figure out exactly what transpires, what actually is the end result. But affordability, every politician, they're trying to save their job, and they're out there trying to show their voters that they're doing something about it. Fannie Mae, Freddie Mac. President Trump has them buying $200 billion in mortgage-backed securities. So Fannie Mae, Freddie Mac have profits. They have a bunch of money in reserves. So he told them, hey, take that reserve money, buy mortgage-backed securities. What did that do? Well, it ended up lowering rates about 0.25%. Okay. Now interest rates jump back up, goes back down. The ebb and flow of the market. But the biggest thing it did was to compact the spread. And what do I say by spread? You have a 10-year Treasury, and then you have the mortgage-backed security. Mortgage-backed security is when you buy a house, they bundle your loan, put it to Wall Street, it's sold as a mortgage-backed security. The 10-year Treasury is the 10-year Treasury. And typically, the historical difference between the 10-year Treasury and the mortgage-backed security is about 1.7. Right now, we're running anywhere between 1.85 or 1.9, somewhere like that. So we have a little way to go to get to a historical 1.7. So interest rates could improve if the mortgage-backed securities come down. But if we turn around and look at 2023, that spread was as high as 3.1, okay? So if you take where the 10-year Treasury is now, approximately 4.2, and you add the 3.1 to it, we would be at 7.3. Interest rates are in the low 6s, high 5s, depending on the loan program you're doing, depending on your down payment, depending on your credit scores, depending if it's a single family, multifamily, investment property. There's a lot of variables too on an interest rate and where they come about, but we're talking about interest rates lower by 1% just because of the spreads. Now, we don't know long term because it looks like around June or so, that money will be exhausted, that $200 billion, but we will see it did have some impact initially. Institutional investors. Trump did sign an executive order to ban institutional investors. Really not a big market mover, but we all know real estate's local. So in some areas, there are a lot of real estate institutional investors. So that could have bigger impact in certain areas. But for the most part, it's a super, super small component. But once again, hey, all the politicians want to be seen as they're doing something to combat affordability, and guess what? Wall Street, these big institutional investors, the big bad wolf, it's an easy target, to beat up. So we'll see what transpires, with that. Capital gains reform. This is something that everybody should get on their phone, call their politician up, and say, we want capital gain reform. Okay, in 1997, Congress passed that if you sell your home and you make money off the sale of your home, you don't have to pay taxes if you're a single individual on the first $250,000. If you are a married couple, you don't have to pay taxes on the first $500,000 of profit. But understand, in 1997, the average house sold for $200,000. So now fast forward to 2026, the median price, the average sale price in the United States is over $400,000. So imagine if you're living in a house, husband and wife, and the wife passes away, the husband passes away, one of them passes away. Now you only have an exemption of $250,000. You could own a house that the house is worth $500,000. Hey, if the median is over $400,000, it's quite possible, right? And you now have to pay tax on $150,000, $250,000. So what is that doing? Well, you have some people who are not selling because they don't want to have to pay a capital gains of $30,000, $40,000, $50,000 on the sale of the house. They rather turn around, stay in the house, live in the house, and then will the house to their children where they have to pay zero capital gains when it comes to that. Because if you inherit a property, you don't have to pay capital gains. You just have to pay whatever the state inheritance tax is for it. So would reform on the capital gains free up some properties? I would think so. Heck, if I'm older and I want to be in a rancher, or if I want to go into a 55 and older community, well, guess what? I may sell my house if they raise the limits to $500,000 for a single person and $1 million for a married couple. And now I don't have to pay that capital gains. I can roll all the money from the sale of the house right into my new house. And the older Americans, if they go into these 55 and older communities, it's not like you're taking a house off the market. You know, typically when you sell a house, you buy a new house, so it's one for one. So you're putting a house on the market, but you're taking one off. But here, you're putting a house on the market, but you're really not taking one off because a first-time home buyer isn't buying a 55 and older community. So that could be something that could move the needle. Once again, 1997, we're talking 30 years, the last time they adjust these numbers. It's long overdue. It's something that should happen. FHA, they came out with their balance sheet, and they showed that they have 11% monies in reserves, where Congress mandates they have to have at least 2%, and that's for foreclosures, fallout, that kind of thing. So they're way, way ahead of the statutory mandate of that 2%. Well, what could be done? I think we could lower mortgage insurance premium. Not forever, but hey, if we lower the mortgage insurance premium for 2 years, 3 years, 4 years, now you're going to make houses more affordable, because now if my mortgage insurance premium was $100 a month and it goes down to $50 a month, well, it's $50 cheaper, for that house. Every little bit helps. And what will happen to that reserve? Hey, maybe it'll go from 11% down to 6%, 7%, well above the 2% that is required, that's mandated from Congress. That's something that they should do, and I expect that will happen. Last thing. Scott Bessent, the Treasury Secretary, he's talking about lowering the requirements for banks of having monies in reserves. So the way it works right now is if a bank gives a loan out to, mom and pop buying a dry cleaner or whatever for their business, whatever the case may be, when it comes to it, the bank has to have monies in reserves. So Scott Bessent isn't talking about that. What he's talking about is if the banks invest into U.S. Treasuries, they wouldn't have to leave money in reserves for that investment. Currently, right now, they have to. So once again, we're not talking about the loans that banks do. We're talking about if they buy U.S. Treasuries. And the reason why Scott Bessent is saying that is, hey, U.S. Treasuries are guaranteed. It's backed by the government. And hey, if the government can't pay their debt, their U.S. Treasuries, guess what? The whole world is collapsing, because there's trillions of dollars of people throughout the world that buy U.S. Treasuries because they're looked at as guaranteed, okay? So the thought process behind all this is that banks will turn around and will buy some of these U.S. Treasuries. And when they buy these U.S. Treasuries at, 2%, 3%, 4% return on their money, they won't have to allocate any monies on reserves for them. What that will do is will create competition for these U.S. Treasuries. So the more people wanting to buy U.S. Treasuries, the lower the price of the Treasury can be. So Scott Bessent is thinking anywhere between 1/4 to 0.5%. That could lower rates. So to me, it's a no-brainer. I think that's a brilliant idea. If they can get that passed, obviously, that would have to be voted on to be able to change some of these banking regulations. So here's just some stuff that are being talked about and items that are done already. Now, the big key is going to be the State of the Union. The State of the Union address next week. I believe Trump is going to lay out his whole agenda. So we'll see if some of these things make it or what new things, come on board. One thing, the president does not disappoint. He wakes up, whatever comes into his mind, he throws it out there and see if it's going to stick. So that's your little update in the market, what we're seeing, some of my thoughts behind it. Be sure to follow the show on Facebook and Instagram, and follow the show or watch the show on YouTube, The Real Estate Show with Pat Lopez. Remember, we talk everything real estate, no limits. Hope you enjoy the show, and I'll see you next week.